The question of whether we're living through an AI bubble is one of the most debated topics in the financial and tech world right now. Every few decades, a transformative technology comes along that promises to change everything. We've seen it before: railroads in the 1800s, the internet in the late 1990s, and crypto just a few years ago. Each time, early excitement turned into frenzy, valuations exploded, and then reality brought everything back down to earth. The question today is simple but crucial. Is AI the same story all over again, or is this time truly different? To answer that, we need to look at what defines a bubble. A bubble happens when prices rise far beyond the underlying value of an asset, driven more by hype and speculation than by fundamentals. Investors start buying not because they believe in the long-term potential, but because they think someone else will pay more tomorrow. Eventually, that chain breaks. And when it does, valuations collapse and the market resets. When it comes to AI, the hype is undeniable. Companies like NVIDIA, Microsoft, OpenAI, and countless startups have seen explosive growth in valuation. NVIDIA alone has become one of the most valuable companies in the world, fueled almost entirely by demand for AI chips. Stocks tied to AI surged hundreds of percent in 2023 and 2024, and that spilled into every sector. Finance, healthcare, manufacturing, even fast food chains are talking about AI transformation. But as with every boom, the real question isn't whether AI is powerful. It's whether the current pricing reflects reality or fantasy. Let's start with the fundamentals. Artificial intelligence has undeniably made rapid progress. Generative AI, like ChatGPT, has gone from niche to mainstream in under 2 years. Businesses across industries are integrating AI tools for customer support, analytics, logistics, and creative work. Productivity tools powered by AI have reshaped workflows, and companies claim billions in potential cost savings. This isn't like the dot-com bubble where many companies didn't even have a product. AI actually works. It's creating measurable efficiency gains, new products, and in some cases, entirely new markets. But that's only half the story. When technology advances this fast, markets tend to overestimate short-term impact and underestimate long-term change. The excitement can push valuations far ahead of what revenues justify. For instance, when investors pour billions into AI infrastructure, GPUs, data centers, and startups that haven't yet found a path to profitability, it starts to look familiar. The same way investors in the early 2000s believed every company with a .com in its name was destined to win, today, any company mentioning AI in an earnings call seems to get an instant stock price boost. Let's look at the numbers. In the US stock market, AI-related equities have added trillions of dollars in market capitalization since 2023. NVIDIA's revenue and earnings have skyrocketed, but its valuation, trading at over 30 times sales at its peak, suggests expectations are sky high. Even if growth remains strong, it's unlikely to sustain that pace forever. The same happened during the internet boom. The technology was real, but the expectations were unrealistic. Amazon, Google, and eBay survived and thrived, but thousands of others didn't. The survivors became titans, but investors who bought at the peak of the bubble had to wait years to recover. So are we in an AI bubble right now? The most honest answer might be partially. Some parts of the market are certainly overheated. Companies that have no direct AI product or clear monetization strategy are being valued as if they've already achieved massive AI-driven profits. We're seeing speculative capital flood into startups with vague business models and no path to revenue. That's a classic sign of a bubble forming. But at the same time, the underlying technology, unlike many past bubbles, is revolutionary enough that even a market correction wouldn't kill it. It would only separate hype from substance. We can think of the current moment as similar to the early 2000s internet era. Back then, the internet was transformative, but investors jumped the gun. They poured capital into everything internet-related, assuming profits would arrive instantly. When the crash hit in 2000, most of those companies failed, but the infrastructure remained. Broadband expanded, cloud computing emerged, and within a decade, the web reshaped the global economy. The bubble burst, but the long-term impact was undeniable. The same may happen with AI, short-term overvaluation, long-term revolution. Another indicator to watch is the flow of corporate spending. Big tech companies are investing tens of billions into AI infrastructure, training models, and expanding data centers. While that spending has driven enormous profits for chip makers, it's not yet clear whether those investments are generating equivalent returns for the buyers. If these companies don't start seeing meaningful revenue growth from AI applications soon, Wall Street could begin to question whether the spending is justified. That could trigger a valuation correction, similar to how telecom companies crashed after overbuilding internet infrastructure in the early 2000s. But AI isn't limited to hype. It's also creating real-world disruption faster than any technology before it. Unlike the early internet, where adoption took years, AI is already transforming productivity and automation in real time. Businesses are cutting labor costs, developers are accelerating output, and industries like healthcare and logistics are seeing tangible improvements. In finance, analysts are using AI to detect fraud and analyze markets. In entertainment, it's reshaping content creation. And in education, it's changing how people learn. These are deep structural shifts, not just hype. However, the darker side of AI adoption is the pressure it's putting on smaller companies and workers. Many fear that automation could eliminate jobs faster than new ones are created. If productivity gains from AI don't translate into broad economic benefits, we could see political and social pushback, similar to what happened during the industrial revolutions of the past. That risk adds another layer to the question of sustainability, because bubbles often pop when optimism collides with human reality. The investment side is also evolving. Venture capital funding for AI startups exploded, but as returns take longer to materialize, that funding may dry up for companies without clear revenue paths. The same happened during crypto's boom and bust cycle. Initial euphoria gave way to skepticism as many projects failed to deliver value. The pattern may repeat in AI, with a wave of consolidation where only the strongest and most practical companies survive. Now let's talk about public perception. AI is in the headlines daily. Every CEO mentions it. Every investor wants exposure to it. When mainstream media starts treating a technology as inevitable, that's often when valuations start running ahead of reality. People aren't buying because they understand the business model. They're buying because they're afraid of missing out. That's the essence of bubble behavior. However, dismissing AI as just a bubble would be a mistake. Unlike fads or speculative crazes, AI has already proven utility across multiple sectors. What's likely to happen is a cycle of boom, correction, and stabilization. Early investors in true innovators will still win, but the speculative layer, the hype around every small company claiming to have AI in its name, will probably get wiped out. The next few years will be about separating real innovation from marketing. Companies that use AI to genuinely enhance productivity, reduce costs, or create new capabilities will thrive. Those using AI buzzwords to attract funding or inflate valuations will disappear. That's how every technological revolution matures. So, are we in an AI bubble? The short answer? Yes, in parts. Valuations are stretched, expectations are sky high, and speculation is rampant. But beneath that, a real technological transformation is unfolding, one that will define the next decade of global growth. The key for investors and innovators is to recognize the difference between temporary hype and permanent progress. If you're investing in AI today, the smart move is to focus on fundamentals. Look for companies with proven products, recurring revenue, and a clear monetization path for their AI innovations. Avoid those whose entire valuation rests on promises that might never materialize. And be prepared for volatility, because when the bubble phase cools off, it will test conviction. Every major innovation cycle follows this path: overexcitement, correction, and then sustained growth. AI will likely follow the same pattern. Whether we're in the middle of that first phase or nearing the correction remains to be seen, but one thing is clear: the world will never go back to what it was before. Artificial intelligence is not a fad. It's the foundation of the next industrial era. But markets? They always get ahead of themselves. So yes, there's a bubble, but underneath the froth, the future is still very real.